Hello and welcome to the next installment of Diversified's monthly investment video series. My name is Mike Horwath. I am the Chief Investment Officer here at Diversified. What I want to spend a few minutes talking about today were economic indicators. The reason this is timely is, as everybody knows, markets are a little bit volatile right now. Economic conditions are very uncertain. Inflation's running high. The interest rate environment is rising from the Federal Reserve. Concerns over slowing economic growth are rising, and that good old-fashioned R word's being thrown out, the word recession, with regards to where economic conditions are going. So we get the question often, Mike, where do you look for information about where economic conditions are going? Are we really going into a recessionary environment? How do you make portfolio decisions in a world filled with different types of information with regards to economic data? For me, the best way to walk through this is to think about it from a leading and lagging economic indicator perspective. What are things we're looking at for where the economy is going? Those would be leading economic indicators. Those are things that often precede changing economic conditions, right? As economic conditions start to worsen, right, we would have expected to see certain data points begin to worsen, right, or turn preceding that. And on the flip side, during a recession or after a recessionary environment, there are things that we would expect to come out that would be more lagging economic indicators. So on the leading side, there's things like manufacturing activity, retail sales. The stock market actually does a pretty good job preceding recessionary environments. The yield curve, right, the bond yield curve, you hear the term an inverted yield curve, is something that often precedes economic conditions changing. Those are leading economic indicators. On the other side, you have things that are more lagging, right? Things that show up after the fact. These are often items that are a result of a recessionary environment, or they are just measured less frequently and maybe will not be able to be as high frequency and ultimately come out after the fact. So GDP, unemployment happens to be a tool that we can use that tends to come after the change in economic environment. So it's important to understand the differences, right? When we see GDP growth dropping, that's not really what we're waiting for, right? We're waiting for things that precede reducing or increasing GDP growth here domestically or globally across the board. So how do we think about leading economic indicators? Well, by reviewing them historically, right? By thinking about them as being proactive and not reactive, we can help to make portfolio decisions by understanding where economic conditions are going, right? Naturally, as you would expect, leading economic indicators should hopefully lead us to where the economy is going. So this is something we'll do on a very frequent basis. People, like I said, will look at GDP growth. People will look at unemployment and say, hey, well, that's where the economy is going. Well, typically that's actually after the fact. So something we'll look at for an example is the yield curve. This may not be the most popular one amongst investors, but it's something that certainly gets talked about a lot when it does invert. So when the yield curve inverts, what that ultimately means is short-term bonds out-yield longer-term bonds. It's not very intuitive, right? Somebody who buys a 2-year bond is being compensated higher or getting more yield on that than someone who buys a 10-year bond or a 30-year bond potentially. That's what's called an inverted yield curve. Why is that important? One, it's a very unique environment that we need to understand why that's the case, because the long end of the yield curve, so longer term bonds, are driven by GDP growth and inflation, and the short term is mostly driven by what the Fed's doing. So if the short term is rising and the Fed's raising rates, but the long end saying we expect GDP growth and inflation to drop, that is likely an environment that precedes worsening economic conditions, at least historically has been. So you'll see on the graphic that over the long term, this phenomenon that we circled in red circles has often preceded recessionary environments by 12 to 18 months. That's the catch, right? It's important to understand that even if indicators go off, even if the data starts to lead us in a direction where, hey, economic conditions are worsening, at least that's what the data is telling us, it's not always a overnight thing. It's not next week, not even next month. On average, it's typically 12 to 18 months for an inverted yield curve. So it's understanding that as a component of these other pieces of economic data. Other things that we'll look at is something at a more broad level, meaning we'll use different firms like Legg Mason, which is now owned by Franklin Templeton. They put out a good dashboard that we love to review frequently called The Anatomy of a Recession. And sometimes this is a good perspective for us because sometimes your gut feel makes it feel like economic conditions are worse. Well, sometimes we need the data to back that up. So the Anatomy of a Recession does a good job of helping us understand in prior recessionary environments, what did the different data points tell us, right? Were they all flashing a concerning signal? Were some good, some bad? And what you see is that there's a pretty consistent scenario where most were moderately bad to very bad in that scenario. And we're talking manufacturing activity, weekly unemployment claims, wage growth, things like that. And what you see today is, well, we're not necessarily in that condition, right? There are some that are starting to concern us, right? There are things that we're looking at. However, it's important that the data starts to lead us down the right path to go along with some of our fundamental beliefs of where economic conditions are going. But that is an example of something we'll look at. So in total, Diversified's investment team, right, our investment committee uses economic indicators, especially the leading economic indicators, on a weekly basis. We review these dashboards to understand what's happening in the economy, what's happening in markets. Where do we need to take portfolios? Do we need to get more defensive, or does it warrant being in a more pro-growth environment? All right, so things that we're going to look at are the yield curve, right? So the 10-year and the 2-year yield spread. We're going to look at weekly unemployment claims. We're going to look at retail sales, right? Oftentimes, retail sales and manufacturing activity will lead us to where economic growth is going. And there are different indexes that we can also use that help us measure these types of things. Today, the concerning parts are two things, right? It's consumer sentiment and it's the stock market, right? The stock market often does a good job preceding these things, or at least leading us down this path. And the second would be consumer confidence, right, or consumer sentiment. Consumer sentiment is extremely low right now. I think inflation has clearly weighed on investors' minds. But it's important to understand that we have to look at these indicators in aggregate. No one indicator or no one data point will always lead us to the right place. So I hope this was helpful to understand how Diversified thinks about leading and lagging economic indicators. They are important data points that we review, and we have dashboards internally that we review on a weekly basis as an investment committee. They will help guide our decision-making process and work in tandem with the other data that we use in terms of market valuations and things along those lines. But if you have any questions, don't hesitate to let us know. We know markets are turbulent. We know it's been a very choppy environment. And if this can make you anxious, just let us know if you have any questions or if there's anything we can do to help ease your mind. But as always, we appreciate the trust you put in Diversified. Stay wealthy, stay healthy, and stay happy. My name is Mike Horwath. For all of us here at Diversified, take care.